All. Hopefully you can all hear me. Just want to quickly say good evening and thank you for joining. Hopefully you know my my name is Dane and I'm the Chief Commercial Officer here at Camma Capital. So look, tonight is we're going to be discussing the trading during the geopolitical instability. And look, I know it's been a tense few weeks for many people, particularly in this region, and I think we're all seeing and feeling that in the markets as well. So, look, the purpose of tonight is simply to take some of the uncertainty, break it down properly, and just help, you feel more comfortable with what you're looking at on the screen. I don't want to overcomplicate anything. The aim here is just to make everything a lot clearer and a little bit more conversational and informal. And hopefully by the end of the session, you'll be left with a much better understanding of, how the global markets, the events, they feed into the market, how volatility changes trading conditions, and hopefully how you can approach that environment, with a lot more confidence and control. So the agenda, hopefully what we'll learn tonight. So I'll just quickly walk you through where we plan to go tonight. So we'll start by looking at why global events move markets in the first place and what the events are actually changing underneath the surface. From there, we'll look at what happens when, volatility rises, because that's usually the point where trading conditions begin to change quite considerably. And then we'll look and we'll go through all the different assets, how they react in, the certain periods, particularly, FX gold, oil, and indices. And after that, we'll spend some time talking through uh, you know, the common mistakes that we kind of see from traders, especially when the conditions become very unstable. I mean, in my opinion, most of the mistakes that we're seeing are avoidable, especially when you're educated and you know what to look for. And then we'll finish with, a practical side of things, how professionals tend to think in volatile conditions, and then how you can build a kind of a framework, a trade setup on your own. So I don't want to, the aim here is not to just explain the market. It's mainly to give everyone a structured way to think about it. So why this topic matters? I mean, this topic matters because over the last few years, the markets haven't exactly been short of shocks. We've had things like COVID, we've had, war, Russia, Ukraine, the geopolitical tensions that we're seeing here in the Middle East. We've had global sanctions, we've had the inflation shocks, we've had policy changes, we've had the elections. I mean, all of these big events have forced the markets to kind of reprice, reconsider kind of growth factors, inflation factors. Um, and obviously, from a client perspective, if you're only looking at the chart, those moves can just feel completely random. Maybe a level breaks very aggressively, or gold jumps extremely high, or there's a big spike in oil. Maybe an index sells off. I think everything can look very disconnected or a little bit chaotic. But once you understand the kind of the story or the macro structure behind the move, for sure it's going to make much more sense. And I think that's the point. Uh, the more you understand, what the market's reacting to, I think the less likely you are to, misinterpret every sharp move. For sure, it's still going to be volatile, but by the end, hopefully the moves will stop feeling mysterious. So, Kama, before we go any further with the presentation, I just want to, introduce Kama Capital, who we are and what we're about. So Kama are a UAE regulated brokerage with, a retail and an institutional coverage. We have a very broad client base from, your everyday trader, your individual investors, through to professional and even the institutional participants. Our offering is a multi-asset environment. We allow all of our clients to trade FX, commodities, metals, energies, indices, the global equities, futures, crypto. And a big part of what we offer is focus around education. My plan as Chief Commercial Officer, and something I take quite seriously, is giving our clients the education, allowing them to understand what they're doing, to give them, the true understanding of how to manage risk themselves and how they can approach the markets directly, and hopefully with a lot of confidence as well. So, global events and market moves. I mean, this is before I think we go and we talk about the volatility itself. It's worth understanding what kind of global events actually move the markets in the first place, and more importantly, why they move. Generally markets react, most to events that change maybe one of a few factors, looking at growth, inflation, interest rates, risk, maybe even supply. So what sort of events are we talking about here? I mean, as the slide is showing, we're talking about things like, war, any form of military escalation, sanctions, global sanctions, trade disputes or conflicts. We're talking about political instability, the elections, anything that, will change major policies. That could be central bank decisions. We've seen, a lot of inflation shocks, supply chain disruptions, anything that really affects the kind of the energy commodities and even the investor confidence is what we would consider a global event. And the reason these events matter is very simple. They change expectation. I mean, if you're an investor and you potentially think that the growth is going to slow, or inflation will rise higher than your return on investment, or the risk is just too increased, then you're going to move money. You're going to move it to somewhere else. And that is where we see the big moves. That's when, traders are reducing their exposure. Maybe they're moving it from one area and they're increasing it into another. A lot move from, high risk investments to safe havens. Some they're cutting their risk completely. So the market's not really reacting to the headline itself. It's reacting to what the headline means. What's the next step? And I think that's what we're trying to educate. And that's the kind of the plan that I want people to understand tonight, is that these price movements, they're not random. And in most cases, they're just the market adjusting to, new information, new expectations that all come from the kind of the global events and maybe some of the comments. I mean, obviously Trump is one of them factors that we all have to be aware of some of the things that he's going to say or change. So what happens when volatility rises? I mean, the key word here for me is uncertainty. As soon as that enters into the market, the first thing that changes is volatility. And what does volatility mean? It's simply put, it just means how far and how fast prices will move. And you'll see that in the charting itself. We in periods like this, we see a much wider intraday range. You see the sharper swings, quick reversals, very chaotic charts, a lot of quick movements in and out. And most of these moves that we're seeing, they normally in calm markets, they take, hours, maybe days to kind of develop and reach. But during the volatility and the geopolitical uncertainty, these moves can happen in a matter of seconds to minutes. Another key factor as well is alongside all of this, trading conditions themselves will change. That means spreads can widen. Liquidity will become very thin. Prices will move through the levels much faster than, the people are used to in these calm markets. I mean, look, that all matters because especially with traders who are used to the calm markets because they have a trade setup that, maybe worked and was completely fine in a quiet market. But when they apply that into a volatile one, it will be completely different. And I think that's where a lot of the traders get caught out. They keep the same position size, they keep the same stop loss distance, and they keep, I mean, the same assumptions that they were using in the calm market. But obviously, if the market is moving faster and it's covering much more ground, you're not technically taking the same trade anymore. You're inherently taking more risk. So I think the key point here is when volatility rises, your environment has to change and your approach has to change. And if your approach doesn't change, then your risk will significantly increase, whether you want it to or not. Okay, how different markets react. So yeah, again, when uncertainty, volatility, when everything rises, the different markets they they react in a completely different way, but they're all responding to the same underlying story. Currencies, for instance, you'll see lots of investors, you'll see lots of money moving towards the safe haven, the kind of the safe currencies, which I think most people know are, the US dollar, the Japanese yen, or the Swiss franc. It's a key point to note is that doesn't mean that, the candles or the trades that they're going to go in a straight line every time. But in periods of, risk off, the influx and the demand in these instruments, it shows up very clearly. Gold. I mean, I think everyone is aware that gold is the safe haven, is the old the old hedge, the old attraction during the geopolitical issues. You see whenever there's a stress event, it always comes back into focus. Everyone wants to start buying gold. And it's not just, retail, it's not just, your everyday investor. You have the banks, you have the funds, you have countries. All of them will increase their exposure as a kind of a hedge against the uncertainty or the inflation or maybe their currency weakness. And then you have oil and gas and energy. I mean, these react mainly due to the geopolitical tensions. I think we've seen that play out recently with, the Strait of Hormuz. That if supply is threatened or a shipping route is disrupted, then the market will reprice and move extremely quickly, and the consequence will be seen immediately. I mean, and another key thing is when oil prices are as high as they are now, it's certainly not favorable for the economy. So and indices, it's basically highlighting the risk sentiment. As soon as investors become nervous and they stop thinking about individual stocks, they want to reduce their exposure to the market as a whole. So that's why when the kind of the geopolitical risk increases, you'll see all the indices will fall together. So yeah, I mean, I think, and I keep saying this, but once you understand how the market fundamentals work and how the chosen market tends to behave, you're much less likely to get caught off guard or reacting emotionally. Uh, Common trading mistakes. So when volatility picks up, um, you know, the mistakes that traders are making, they become so much more obvious. A key one here is chasing the headline. Maybe a major story has broke. The market has moved extremely quickly, and a lot of the traders have no idea why that's happened. So they enter in late. The move could have, maybe gone up 1%, maybe due to, fear of missing out, or, maybe the psychological aspect. They wish they'd been part of the move. So obviously once they enter, they have no reason to enter. They're just chasing something, a move. Statistically, once they enter, it'll be too late and the market will move against them. And that's when we will see obviously liquidations happen. Another key mistake is overtrading. And, it's especially in the volatile conditions, there's a big temptation to feel like you need to catch everything. You feel like I need to be part of every single move that's happened. Maybe one trade worked, so you feel like that you can replicate that on every single move during these volatile markets. But it doesn't actually result in better trading. I think if anything, over trading is it's normally a sign of emotions. It's not control over the markets. I think it's when you lose control, and when you lose control, you definitely lose your edge. Another common mistake is the position sizes. I mean, oversizing is a key mistake that we see a lot. You know, people will get used to the quiet conditions, the calm markets, and they're comfortable with a certain lot size or a trade size. And they continue to use the same trade size even when the market, maybe the range has doubled. So without realizing it, they're taking on double the risk. And then another key factor is ignoring the changes in volatility and spreads. I mean, I define that as execution. You know, many people ignore the fact that spreads will widen, prices will move much more aggressively. The liquidity will be much thinner. So during these moves, there could be an aspect that when they enter into a trade, maybe they're placing their stops much more closer, or tightly, or take profits tightly, and then they've, completely surprised when they're triggered. I mean, we hear it a lot, that a lot of people think that, their stops have been found or they're being hunted by the market. But unfortunately, a common mistake here is they're just placing them way too tight to their trade entry. So I think, in short and in summary, the market changes, but traders' behavior stays the same. And that gap between, changing the conditions and changing your behavior is where a lot of the unnecessary losses come from. Okay, approaching volatile markets. Sorry, just before we do this, I haven't mentioned about the questions. So we will, at the end of the webinar, we will have a Q&A session. So if anyone's got any questions, try and remember them or write them down. And at the end, we'll have a kind of an open floor for you guys to just, ask as much as you want. So approaching volatile markets. So when the markets become unstable or volatile, I think the first approach, or the first step is not to, fight it. Is just to recognize it and accept it. And becoming and adapting a more professional approach is key here. Things change on a minute by minute basis. So maybe what worked, or the way you were perceiving the market from the day before, is not how this week that the trading will continue to be. And I think once you accept that, your job or your trade, it will just become a lot more simpler. And the first part of that is clear market structure. When volatility is high, I think most of the experienced traders, they're able to kind of zoom out. They're able to, move away from the small inflictions that are happening on the market, and they're focusing more on the bigger picture, the bigger levels, the broader market structure. They're building scenarios in their head. This is what we should do if this happens, or this is what we should do in the near future. Instead of reacting to every small move or a 5 minute chart, they're zooming out to, an hour to a 4 hour or a daily chart. Another another thing is being selective with your trades. You know, there's always going to be a lot of noise. There's always going to be more movements, in especially with the volatile markets. But I think a lot of traders feel like that means that they have to do more. And unfortunately, what you're supposed to do is less is actually more in these situations. A very good trader will become much more selective in terms of the trades he's going to take than over trading. As I said before, in the common mistakes. So the traders who tend to handle these environments the best are the ones that are patient, not the ones that are more active. And then we have position size. I mean, when the price action becomes very aggressive, professionals will, they will allow more room in the trade. They will reduce their trade size, so obviously they'll be less likely to be liquidated. And unfortunately, that's something that we see a lot in the kind of the retail market. And I think that's something that, we need shifted from our clients to really understand that you need to really consider how much you're risking in terms of the risk reward, as every time that you enter a trade. And then finally, avoid reacting to every headline. I think the objective here is discipline. The key approach here is to stay disciplined during everything that you're doing. And then developing your own framework. So I think, look, one thing that professional traders do, um, is based on how they feel that day. It's, they don't. It's not how they. Sorry, it's not how they feel on the day. It's a structured framework with, what they've preset. The framework will tell them what to trade, what matters, how much risk, when they need to stop. All these factors they've predetermined in a framework. And, these rules are needed. Every single bank, trader, hedge fund, professional has a framework. And yeah, I mean, it starts with being clear. I mean, it even breaks down to the instruments. This is why we see, banks, they have specific desks. They have a gold desk or a FX desk or a bond desk. So that means that you'll get certain traders that specifically focus on a key or specific instrument rather than trading a whole batch. And then you need to consider the kind of events that you particularly want to trade. A lot of people, they prefer trading, maybe interest rate decisions versus non-farms. So there'll be key political or key economic data that they'll focus on, and they will only trade that particular data versus the whole day move. And then something else is the risk parameter. How much you're willing to risk per trade. How much you're willing to lose. Maybe there's a set limit that you're willing to lose before you stop completely. And then, under what conditions do you decide maybe today's not the day that we trade at all? Maybe something hasn't been achieved, or there's not enough information for you to make an informed decision. I think all of these questions, they sound very basic, and all of this information sounds basic, but this is the framework that really matters. Another very useful habit that I use personally as well is looking back. Instead of guessing, how gold or oil or these instruments behave in the future, you can actually study what they previously did during, periods of stress or non-farms back in 2025, let's say in one of the months. And obviously the market will always leave clues, the patterns in the charts. So obviously we can't predict every move. We can't predict the future. So the goal is just to build the framework that is going to improve your consistency. And the key takeaways. So to bring everything together that we've kind of discussed is, I think the few points, the 4 points here are what I would like everyone here to kind of leave with tonight. And the first is that global events, they do move markets. They move them very quickly and it's very aggressively. The second is volatility. I mean, it changes the environment itself. It's not just that the price is moving more, it's the conditions have changed. You know, speed has changed, liquidity changes, the risks behind it, everything has changed. The third is the different assets. You know, the markets, as I said in the previous slide, they will express the same stress, but in a different way. They they tell the same underlying story, but on the surface they look different. You know, and finally, the biggest advantage is in these environments, I think it's not usually speed, it's structure. I mean, the discipline, having the discipline to adapt or manage risk and avoid being pulled into the emotional trades is one of the key points. And risk reminder. I mean, look, before we finish, you know, an important reminder here is trading financial markets will always involve risk, especially when there's periods of geopolitical uncertainty. You know, the risk will increase, um, you know, much more quickly because the price is moving much more faster and larger. So we always recommend to only trade with the capital that you can afford to lose. But where the education comes in is with the education, you can reduce your risk significantly. So thank you. It's been, you know, short and sweet, but yeah, I just want to say thanks again for everyone for coming. Hopefully it's, you know, made everyone feel a little clearer. Maybe it's removed some of the noise, made things a little bit more manageable. And more importantly, I hope that the framework that is given you, you can actually take away and use yourself. You know, it's, you know, you need to be able to understand you need to be able to understand all of the kind of the framework and the structure and the key points that I mentioned, because you don't just want to, the goal isn't just to watch the markets move. It's to trade them efficiently and smartly and properly when the time comes for you actually to enter into that trade. So thank you. Thanks for joining. And like I said, halfway through, if there's any questions, feel free to let me know. If not now, please feel free to message or get in touch with any of the sales team here or my customer support, and anyone will gladly help and assist with anything further. Okay, we have a question here. Can I know, please, from your experience, how important is the broker choice during periods like this? Okay, so a broker choice, I mean, obviously is very important, especially when the markets are under stress. You know, in calm conditions, I think many brokers, they appear the same, very similar from the outside. All the spreads can become or look the same. Everything's quite competitive. The platform's great and everything seems straightforward. But as soon as the volatility kicks in, as soon as the markets become very fast, I think that's where it exposes the weakness, especially if the broker isn't, you know, built or isn't stable. So if conditions are volatile, execution will matter a lot more. And yeah, so I think when you're looking at the importance of the broker choice, they're the key factors that you need to consider. And then we have here for Maria, what should traders actually be looking for in a broker during times like this? So, um, I think in times like these, a key point is support. You need full support. I mean that doesn't even matter if you're a beginner or a professional. You know, every single person needs to be able to fully rely on their broker. So, you know, maybe a checklist that you should have before you onboard or you approach any broker is look for regulation and credibility. I mean, you should definitely look for a brokerage that prioritizes execution. And then, you know, maybe finally, let's keep it to 3 points. A brokerage that offers a 24-hour coverage. Um, because obviously there's nothing worse than, you know, you needing something very urgent and you just have no access to speak to anyone. And then we have here, what's the minimum account size to trade during volatile markets? I mean, there isn't a minimum amount or trade size to trade during the volatile markets. That will come from the strategy and the structure that I've mentioned before. You have to consider your risk and the kind of the risk you're willing to kind of make or lose. And once you build that, I think that's where you can answer that question. So we have here, how critical is platform stability maintaining execution quality during periods of high market volatility? So yeah, listen, I think you know, platform stability is crucial. I mean, obviously, as I said in the previous answer, there's nothing worse than having a trade that's open. And during a volatile market, you just need the stability of the platform to maybe exit a trade, to increase the risk, to, you know, just to log in and see. So I think when the volatility rises, decisions have to be made quickly. And obviously, where the prices will move so fast, the last thing you want is a platform maybe freezing or lagging, or you're having disconnections that happen all the time. So yeah, listen, the platform is extremely critical in that situation as well. So, Sam, what makes a good trading strategy? As I said before in the slides, a strategy is a very personal kind of approach that kind of works for you. So a strategy would be someone approaching the markets with all of the knowledge and understanding of everything that I've said, and obviously assessing their risk depending on the volatility that they're seeing. So, I mean, there's lots of strategies in the market that people trade with. There's obviously scalping, which is extremely high risk. So before before you answer that, you need to analyze what type of trader you are, and you know where you perform the best. Once you understand who you are as a person, your approach to the markets, then obviously you can build the strategy, because some people may be very risky. A lot of people like the thrill of, you know, the fast moves getting in and out very quickly, and some like the long-term investments. Sorry, there's a lot coming through. What's the next one? Do you think it's better to use an EA to avoid emotional decision making? Yeah, listen, EAs are a very good choice to remove the emotional side of things. However, an EA is only as good as the kind of the coding or the strategy that's been embedded into it. This is why I would much rather the clients that we work with to be able to educate themselves on the market and actually understand that they have to remove the emotions themselves. And once they remove the emotions themselves, they will be able to, with the education and the knowledge of the market, they'll be able to trade a lot better than the EA. But obviously, at Gamma and the platform we use, EAs are fully functional. And here we go. How do you classify and handle toxic flow or latency arbitrage? So, very good question. So, the way we classify I mean, it's very easy to see. It's very easy to spot latency arbitrage. Obviously, there'll be maybe an inefficiency with the technology or the kind of the aggregator or the technology and the bridging that we're using and the pricing, the liquidity. And obviously, traders will come in and they will try and abuse the inefficiencies in the structure that we have. So we can see that pretty much instantly. Obviously, we have risk management controls internally that will flag kind of suspicious activities like that. And I mean, the way we classify that is if someone is abusing it, they will be in and out extremely quickly, normally within milliseconds to seconds. And yeah, listen, it doesn't matter about the P&L. A lot of people that we see that are latency arbitragers, um, they will share a statement that will show that they haven't made consistent profit. So it's got nothing to do with the profit. It's the abusive nature of the trading that we just don't want and we don't like because the issue of latency arbitrage is, from a camera perspective, particularly, we work very hard with our liquidity providers and internally to provide the best conditions for traders and genuine traders to execute on the market. Now, in order to get the liquidity that our traders need, we have obviously very good relationships with our prime brokers and our banks. So we put the protection levels in to stop them from getting hurt by the flow that we're sending to them. So yeah, toxic and arbitrage strategies are something that is obviously a problem in the industry at the minute. What is the process to open an account with Gamma Capital? Listen, the process is extremely easy. I'd recommend you to take a look at the website. We have a very big sales team here at Gamma as well. So feel free to either ring, send an email, and you can speak to our customer support or the sales team who will guide you through step by step how to do it. But it's a very simple process. You can log in online, you can see the website, and the stages are very clear and easy to complete. Do you give recommendations on trades, and what makes you different from other platforms in the market? We certainly don't give recommendations on trades. What we, like I said, and I think hopefully everyone understands the theme of what I'm trying to say here is we want our clients to trade themselves. We want our clients to make their own decisions based on the education that we provide. So recommendations on trades doesn't work. There are obviously certain things that we have that are indicators that will provide maybe an overview of what's happening in the market, whether things look bullish or bearish, and we will provide that on the platform. But in terms of definitely trade recommendations, we don't do. What makes you different from other platforms in the market? I mean, what makes us different is our approach to the market. I think a lot of brokers in the not particularly in the region, but globally, they adopt a model whereby they tend to not want to work with the clients directly. They don't want to. I think there's conflicts of interests. I think anyone that's been in the industry long enough can understand that a lot of the models and business models and approaches that brokers take is the other side of the client. If the client makes money, it's damaging to them, and if a client loses money, they make. So that's where we're different. We are an STP broker. We want our clients to make money. We want our clients to be fully educated, and we want them to be the best that they can be. And yeah, that's of considerable difference in terms of how Gamma are different in the market. How fast is the withdrawal process? I mean, look, we are considered one of the fastest in the industry. It's something that we pride ourselves on internally here. And the withdrawal process, depending on which method you're using, obviously bank transfer, it will, from our side, we action that immediately. So as soon as the withdrawal request is received internally, obviously the checks are done, and it's normally within a couple of minutes, and then it's approved and then sent out. Unfortunately, we can't then control what happens thereafter. Maybe your banks are doing additional checks before it's received. But as I said, from a camera perspective, the withdrawals are extremely fast. Um, I've seen HFT accounts on the website. Can you elaborate? Yeah, so thing about Camma is like I say, we're all about giving back to the clients. And a key theme that we've seen throughout kind of the region particularly is that a lot of clients want to trade uh, quickly, high frequency. So HFT stands for high frequency trading. So we're seeing a big increase in funds in the region, EAs as well that was mentioned earlier. All of these trade are much faster. Yeah, they're in and out very quick. So we created a bespoke feed that is unavailable. I've personally not seen it at another broker. We've we've created that feed particularly for these clients that rely on very good execution and very fast execution, and that was where we created this HFT account. I mean, all of the information is provided on the website, but and as I said before, if there's any questions after this, and maybe you leave the webinar and you go home and you have more questions, please feel free to ring Kama, any of the phone numbers. It's something that anybody here from the customer support, the sales team, be more than willing to give you all the information. And have I missed any? Where are we here? Okay, I think that is it. I'm in Brazil. Can I open an account with Kama? Yes, yes, we cater to the global markets. We cater to anyone globally. We have obviously on our website the kind of the restricted the countries that we're not allowed to approach. But like I say, please feel free to visit the website, and you'll find all the information there. And then we've got sorry here. So if I'm going to open an account, what should I focus on first? So if you're going to open an account, I think maybe I've kind of maybe touched upon this on certain other questions, but what you should focus on first is obviously becoming familiar with the market. Depending on your level of experience, I think you need to let's say you're a beginner. What you need to do is you need to take some time to educate yourself. My sales team will, I keep mentioning the sales team, but they're very good at what they do. We offer obviously a very hands-on approach. We will give you a lot of their time, and they will help you, they will educate you, they will get you set up. And you can kind of tailor and speak to them, bounce ideas off of them, and create your own strategy. So I think the first thing to focus on is analyzing your risk, how much risk you're willing to take versus the deposit that you're going to place, and then from there build on the kind of the environment and the instruments that you like to trade. I mean, a key instrument at the minute is gold. Gold and oil are obviously very volatile, and everyone wants to trade them. Thank you, Dane. Okay, thank you. Great. Doesn't look like any more questions from anyone, but as I said before, I appreciate you taking the time to, I mean, especially in the evening, take the time to be part of this webinar. And if any questions come to mind, as I said, feel free to check the website or make a call, and anyone at CAM will be happy to help. Thank you. Thanks, everyone.